Hello and welcome back to Money Never Sleeps. My name is Mac from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. Today's episode is focused on retirement planning for Generation X, a group that often feels a little stuck in the middle. Gen Xers are approaching retirement age. Many are still working and earning, and most are doing what they've been told to do for years, contributing to retirement accounts, investing for growth, and trying to stay on track. Yet a common question I hear is this: I'm saving, I'm investing, but how do I know I'm not missing something? If that question sounds familiar, this episode is for you. During our conversation today, we'll be referencing a U.S. News and World Report article that's headlined, "Here's What Gen X Should Know About Retirement." When we talk about Generation X, we're generally referring to people born between about 1965 and 1980. That's a wide group financially speaking. Some are high earners, some are business owners. Others are still recovering from layoffs, recessions, or family obligations that interrupted their savings. Despite those differences, everyone in this group is heading toward the same phase of life. And regardless of income or net worth, Gen X tends to face the same three retirement challenges: risk, fees, and taxes. These issues don't always show up clearly while you're working, but they can become very real once retirement begins. One of the biggest shifts people face as they approach retirement is the role of a budget. In many ways, a workable budget becomes more important in retirement than it ever was during your working years. For decades, many Gen Xers have lived with a steady paycheck. Money comes in, bills get paid, savings happens automatically, and spending rarely needs close attention. But when that paycheck stops, everything changes. At that point, cash flow matters more than balances, and that's when many people realize they don't have a clear picture of what they truly spend month to month. This can lead to difficult discoveries, including the realization that maintaining a current lifestyle may not be realistic without adjustments. Those adjustments are much easier to make before retirement, not after it begins. Housing is a good example. For years, downsizing was considered an easy solution, but with today's home prices and mortgage rates, moving into retirement may not be practical for everyone. That makes understanding spending, flexibility, and trade-offs even more critical. Another major milestone for Gen X is age 59-12. That's when retirement accounts like 401ks and IRAs become accessible without early withdrawal penalties. Because traditional pensions are now rare, most Gen Xers have been responsible for building their own retirement savings. Workplace plans and IRAs will likely serve as the primary income source in retirement. Reaching 59.5 can feel like a green light, but access doesn't automatically mean action. An account balance does not equal monthly income. People often don't know what that money actually means in terms of sustainable cash flow. Taking too much too early can increase the risk of running out of money later in retirement. That's why withdrawal planning matters. The goal isn't just access, it's sustainability. Understanding how much to withdraw, when to withdraw, and from which accounts can have a long-term impact on retirement outcomes. Not everyone is looking to withdraw at 59.5. Many Gen Xers are still saving aggressively as they head into their early 60s. Thanks to changes under the Secure 2.0 Act, there's a unique opportunity for people between ages 60 and 63. Workers aged 50 and older have long been allowed to make catch-up contributions to retirement plans. Starting in 2026, that standard catch-up is $8,000 on top of the regular $24,500 contribution limit. But for those ages 60 through 63, there's an even higher limit that's often referred to as a super catch-up contribution, allowing up to $11,250 in additional savings during that window. There are important caveats. Not all plans are required to allow super catch-ups, and individuals who earned more than $150,000 in the prior year must make those catch-up contributions to a Roth account. That means no tax deduction today, but the potential for tax-free withdrawals later. This isn't automatically good or bad. It depends on income, tax planning, and retirement timing. There's also a higher catch-up limit for simple IRA participants in this age range. A common assumption is that taxes automatically go down in retirement. Less income equals less tax, at least in theory. For many Gen X retirees, that assumption may not hold up. The reason is simple. Most Gen X savings are concentrated in tax-deferred accounts like traditional 401ks and IRAs. While contributions were deductible, withdrawals are taxed as ordinary income. No one knows what future tax rates will be, and when most retirement income comes from tax-deferred sources, retirees may be more exposed to whatever tax environment exists down the road. That's why tax diversification matters. One approach discussed in the article is directing future savings toward Roth-style accounts when appropriate. Roth contributions don't provide a deduction today, but qualified withdrawals can be tax-free later. Some individuals also consider Roth conversions, which is paying taxes now in exchange for tax-free income later. These strategies are highly situational. Income levels, Medicare considerations, and long-term goals all play a role. The goal isn't to avoid taxes entirely, it's to avoid surprises. Social Security eligibility is another milestone coming quickly for Gen X. At age 60, unmarried widows and widowers may qualify for survivor benefits. For most people, age 62 is the earliest point to claim retirement benefits. While popular, claiming at 62 can permanently reduce benefits by as much as a third. If you're still working and earning above certain thresholds, benefits may be temporarily reduced further. For those born in 1960 or later, full retirement age is 67. Delaying beyond that can increase benefits by about 8% per year until age 70, after which there's no additional benefit to waiting. Social Security is not a decision to make in isolation. It should be coordinated with taxes, income needs, health considerations, and longevity expectations. Medicare eligibility begins at age 65, even though full retirement age is later. Medicare provides broad coverage, but it includes deductibles, co-pays, and coinsurance, and it does not cover everything. Most notably, Medicare does not pay for ongoing long-term care, such as assisted living, memory care, or nursing home care. Those costs are typically addressed through personal savings or separate coverage. Health savings accounts can also play a role. For those eligible, HSAs offer tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Unlike flexible spending accounts, balances roll over year to year. Generation X largely built wealth through the stock market, and that experience has created confidence. Staying invested can make sense. The challenge is making sure investment strategies evolve as retirement approaches. The years just before and just after retirement are especially sensitive to market downturns. If withdrawals occur during bad market years, losses can become permanent. That's why some retirees choose to diversify beyond pure growth, incorporating stable assets like CDs, treasuries, or certain types of annuity structures to create a volatility buffer. Fees matter here as well. Even small differences can have a meaningful long-term impact. Reviewing investment costs is one of the simplest ways to improve efficiency without increasing risk. Finally, legacy planning deserves renewed attention. Many Gen Xers created wills or estate documents years ago, but life has changed. New marriages, children, grandchildren, and assets can make old plans outdated. Beneficiary designations on retirement accounts and insurance policies often override what's written in a will. Making sure those are current is critical. Legacy planning isn't about complexity, it's about clarity. For Generation X, retirement planning isn't about one decision, it's about how multiple decisions work together over time. Risk, fees, taxes, income timing, healthcare, and legacy planning all intersect. Addressing them early creates flexibility and options. If you have any questions about retirement and your financial strategy, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure. All matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.